Hey folks, David Frost, LazyGapTrader.com. In this video, we're talking about day trading, but more specifically, we're talking about gap trading and how gap trading is by far the single most consistent and profitable day trading strategy you can find across the markets today. I do two things. I teach a course where I teach two specific gap trading strategies. One is known as the morning gap trades, and the second are gap fill trades. Morning gap trades are when stocks are gapping higher or lower at the open. They create an opportunity for traders. The opportunity is for traders that can identify a specific price where these stocks will first be drawn to, and secondly, have a price reaction in the other direction away from. The objective is to figure out how to calculate and how to figure out where those exact price levels are. And that's what I teach in my course. I teach traders how to calculate these specific price levels. Today, we're going to do something a little bit different than we normally do in these videos. I'm going to show you the email that went out to my subscribers this morning at 9 o'clock, 30 minutes before the market even opened for trading. But then we're going to come back to the chart and we're going to pick apart this stock, but we're going to do it in a way where I'm teaching a lesson right out of the course at LazyGapTrader.com. So stay tuned because there's value coming up. Here's the email that went out to my subscribers at 9 o'clock a.m. Eastern Standard Time, 30 minutes before the market even opened for business. As you can see, there were only 3 potential gap trades on the board today, and frankly, for the most part, all week has been quiet. It's been a shortened week because of the Memorial Day holiday weekend here in the US, and therefore, we've just had less gap trades in the morning than we normally do, but that happens from time to time, and things will pick back up in the other direction in no time. The only stock that actually hit its desired level today was Restoration Hardware. I say gap lower. Support levels are $44.37, $42.26, and a third level at $40.16. Stop and profit target is about 30 to 55 cents. These are minimum profit targets. The other two stocks, Workday and Lululemon, didn't hit their levels. So when stocks don't hit the levels we're willing to take a trade at, they become no trades. They're off the board. We're not interested. Let's go back to the chart and take a look at Restoration Hardware, but we're going to turn this into a valuable lesson that is applied not only to the gap trading strategy, but part of this lesson is also applied to all trading. The first thing we want to note is that Restoration Hardware opened below the first level that was identified and calculated as taught in the course. It was $44.37. Any trader that's taken the course is able to come up with the same $44.30 price target that we felt Restoration Hardware should find at least short-term support and have a price reaction in the other direction. But looking at the 10-minute chart, it looks like it just blew through that level and didn't have the price reaction in the other direction. And that's partially true and it's partially not true. And in order to illustrate that further, let's go down to a 1-minute chart so we can magnify what happened minute by minute. Each candle you see on the chart now is represented by 1 minute of time. The first minute of the day, you can see the opening price is $44.24. And that price happens to be below the $44.37 level. Now, we're watching a stock that closed yesterday at over $57 a share. The stock is getting taken out behind the woodshed at the open today, and we're able to identify a number $10 lower than yesterday's close, about 20% lower than the prior trading day's close. We're able to identify a number where the stock actually stops on a dime. That's not the lesson. The lesson here is, in my course, I teach that we're not playing the stock when it opens below the level. So for example, a stock gapping down at the open, we're looking for a certain price level to be support. However, it's very, very important and emphasized in the course that if the stock is creeping lower and lower and lower towards the opening bell, and it actually opens below the level identified. And these levels are given out before the opening bell, so the stock was actually trading over $1.50, almost $2 higher in the pre-market, but it began to drop. And when a stock opens below the level that we've calculated, it takes that particular trade, that particular price level off the board. It becomes a no trade. It reduces the probabilities that this trade is actually going to work out. And therefore, with reduced probabilities, we take the trade off the board. We only want to take the trades where we have the highest probability of success, where we have as much of the odds in our favor as possible in order to have success with the trade. Once those probabilities are reduced, we take the trade off the board. We only want to take the premium trades. Now, as you can see, as soon as the stock came into that level, opened slightly below, just a minute later, it was already a high of $45.16. So the trade technically worked out and certainly produced the type of quick gains that we're looking for. Unfortunately, the trade opened a few pennies below the level, was taken off the board, so technically it was a no trade, but you can see the power of these price levels and how even so quickly produce the type of price reaction in the other direction that we're looking for. That's lesson number 1. Lesson number 2, the stock obviously moved lower. It was coming towards our second price level at $42.26. And here's another lesson right out of the course at Lazy Gap Trader. When a stock comes very close to a price level and has what we call a near miss. So for example, this stock came to a low of $42.33. It missed the price level by 7 cents. After the near miss, the stock had a price reaction in the other direction, making a high just 2 minutes later of $42.95. So that would have produced another positive trade, the precise type of scalp trade that we're looking for at minimum, but it missed the level. We're only interested in playing the stocks at the price level we've calculated, the price level that we've identified. Sometimes we have a near miss. This is one of those times. Then the stock came back down into the price level, but continued to trade lower. And that's why we don't take the trade the second time around. We don't want sloppy seconds. Our best trades come when stocks trade right into the price level. Then we can expect, with a high degree of certainty, a price reaction in the other direction. So lesson number 2, when we have a near miss and the stock consolidates, in this case, slightly over the level, that's the stock telling us that there's a high likelihood that this price level is not going to hold and the stock is going to trade lower. All this is discussed in great detail in the course, but these 2 brief lessons are right out of the course, and what they do is they keep us away from potentially losing trades. They keep us away from the trades that do not have the highest probability of success. And by staying away from those trades, it keeps us in the high probability trades, eliminating the potentially poor trades and increasing our overall win percentage. Throughout the course, I teach not only how to calculate these levels, what criteria we're looking for in terms of the stocks we're playing, how to trade them, how to get the most out of the trades, but I also teach when to stay away from trades, which is just as important as when to get in a trade. The business of day trading is about capital preservation as much as it is about finding the right entry points. And so within the LazyGapTrader.com course on gap trading, I teach all of the above. So everything you saw right here is right out of the course at LazyGapTrader.com. If you want to learn more, come over, check it out. I'm David Frost. Thanks for tuning in, traders.